Hey guys, Mike here. So this is going to be a jam-packed video of data, so pay close attention. It's probably the most data I've ever put in one video, but I want to cover a lot of stuff in this one instead of breaking it up into like 3 different videos. And so I want to cover some of the stuff in employment. That's probably surprised a lot of people today. We'll see how the markets react next week on this. But the other thing is, the number one thing that drives markets, we're going to cover that. And then the other thing is like what's going on with the bank tightening standards, how are companies and individuals looking? That is key to this whole thing. You can almost see and project in a way when a recession is going to hit, if it's going to hit. Again, this is the most anticipated recession in history, so we'll have to see on that one. But we're going to go into all that, and at some point in time, I'm going to go through. I wrote down, I never do a script, but I wrote down the negatives for the stock market, the positives, and then the first that we're just seeing in the market. Okay. And so I just wanted to visually see it and just read that off. And so let's just get started, and let me know if you got any questions in the comments. Now, the employment data came out today. Shockingly, unemployment went down to 3.5. You can see change in non-payroll employment. Everything just kind of came out as expected, right? There's a little gray bar around that. So everything came as expected. I think people were expecting, obviously, the unemployment rate stayed the same at 3.6, but it dropped to 3.5. And then when we sit here and look, you got the change in average hourly earnings. This is the private industries, actually ticked up from the last report. Again, you can see where the 3-month change is and everything. So, people are still getting raises and making more money, which is always, a good thing, by the way, even though the Fed would say it's not because it raises inflation. I mean, again, I'll talk about that one in just a minute. Now, the one to pay attention to, remember, the small companies are the ones in the life force of this economy. The companies that employ 500 people or less make up like 57% of the economy here. And so if you look, this is NFIB, and this is important to see. So now you got job openings at 43%. And if you look to the right, you see all the red arrows going down. All this is slowing down, okay? So obviously there was more, now it's 43% of job openings. Hiring plans, only 15% of companies plan on actually hiring in the future. You can see qualified workers is something they're having a major problem with, by the way. People come in, they're just not qualified for it. Compensation plans, obviously going to increase wages about 22% now. And then, of course, actual compensation changes, 42% of companies. And so that's going down as it was higher before. And so just get a good look at that. And then 2 snapshots of it. Are small businesses hiring workers? Yes, they're still hiring workers. Okay, so that actually is a good thing. Again, it keeps the workforce strong. But on the flip side, looking to the future, are small businesses planning to hire? And you can see this is just keeps on decreasing. Okay, so that's very important to look out for. There's a number of reasons for this. And if you get anything out of this, guys, please hit that like and subscribe button. I really appreciate it. And if you're new, think about subscribing. If you like this content, I really appreciate your support. And of course, we're fixing to go into a lot of that right now, which will be covered in this data coming up. But understand, how does a small business operate, right? If you got 100 employees, whatever it is, you depend on a lot of the regional banks, right? Because you are a smaller company, so you want what? Revolving credit line. You need to take out loans, everything to keep your payroll going, right? And of course, as you're fixing to see, that is becoming harder and harder for smaller companies, especially with the crunch on regional banks right now, okay? And so, we're going to get into all that, or what I mean by crunch on regional banks. But again, if you look at what index is doing the worst, the Russell 2000. What does the Russell 2000 have? It has smaller cap companies, all small cap companies, okay? And so, because those are the ones when you're raising rates way up, and what do these small companies depend on more than anything else is they take on debt to continue to operation and continue to grow, right? That's what they have to do. And when banks are tightening, that makes it harder for them. And if they do have to take out revolving credit lines and take out loans, it's at a much higher interest rate, right? And so that's what you got to think about when it comes to this right here. And that's because all we see is the Apple and everybody else. And we're going to get into all that and discuss how much cash they have on hand, which is something small companies do not. Now, we're going to get into liquidity because this is what drives the market. This is what has drove this rally as well, right? And I cover this every day, update this every day, Monday through Friday for the members because I think it's that important, right? And so this chart has a long name. You can find it in TradeView and everything else. We're going to go into the 3 components that make up, this chart right here. But if you look, the orange part's the Qs, the QQQ, and then, of course, the other one is the liquidity. As liquidity goes up, what happens to the stock market, especially tech? It goes up. When liquidity comes down, it's taken out of the economy, what happens? All right, tech goes down. As liquidity pops back up at the very right, you can see right there, tech has been going back up. Now, what makes this up? One is the balance sheet of the Fed. As you can see, it is basically 9x'd since like 2003, I believe it is, and it keeps getting bigger and bigger and bigger. And so, that's no surprise there. Two is the overnight repo purchasing program they got going at the Fed. Again, this is not some program that's been around like a super long time. Everything's been around for like a decade or something, and it has not, okay? But this is where the banks park their money, the money market funds park their money and earn like 4.88% interest, I believe, is the interest rate they get on that money. And so the other one, though, is going to be the general account for the Treasury, okay? You can see after 2020 or in 2020, they literally went from 400 billion, which is about the average, to 1.8 trillion, okay? You see how they juiced this thing up? And so that was to pay out all those checks and everything else to get all that liquidity out into the market. So they flooded the market, right? That's the three things that make that up, okay? And so this is what markets look at. Now, this right here is the general account. This shows you right here where they literally balloon this thing up like crazy. And that's why if you ever thought to yourself, how come the market went up in 2020 when the world was shut down? Well, this is it, right? Because they raised all this money up and then they flooded the market out, right, with it. Just push it and push it. So if you ever think to yourself, do fundamentals run the market or does liquidity run the market? It's liquidity. Now, look what happens, and we'll zoom in on another chart later, but when they start raising the account back up, taking money back in, not putting it out, what happens to the stock market? It goes down, okay? And now what's been happening lately, if you can see right here, is they've absolutely drained the account down. So what's been happening? That means money's been going out into the economy, and the market's been rallying on this, right? What has the Fed been doing? Well, the Fed was decreasing their balance sheet, right? So that was hurting the market. All of a sudden, what happened? What did you see when the bank crisis hit? Bam! Huge spike up, 300 billion they put out in loans to these banks, which again, don't matter whether they're buying it out or just loaning it out. It's still money to the market. That is money going out. Don't mean the banks are going to loan it out at all. But hey, that's liquidity being injected into the system, okay? You see they actually, well, you look at this chart, you can kind of see what I'm talking about. You see how they were draining it down slowly, and then boom. Those 2 weeks right there when the bank crisis hit, huge spike up again with 300 billion in loans. And then you can see in the last couple of weeks, they've been draining it down slowly. If you want to get a better view of this, this will show you right here the Fed's balance sheet. You can see plain as day if you go from a year ago over to the latest release, you see what they've done, right? And so if we look at this right here, there's where they started a year ago, and there's where they're at now. And you can see they barely now, because of this increase, taken anything off their balance sheet. And this is what it was. The discount window borrowing, right, at a much lower rate than it normally would be. And then bank term funding program. And so that's to shore up the deposits, making sure the banks have plenty of liquidity on hand. So therefore, they don't have to sell their investments at a loss, because most of them have billions of dollars in unrealized losses right now in their investments, and that's what happened to the other banks. They got a bank run on them, and they end up having to sell at a massive loss of those treasuries and stuff, and so they're trying to keep them having to do that. If you're just curious, the Fed has like $1.3 trillion in unrealized losses on all the bonds and stuff they bought over the last 10 years, because obviously rates have been going up. That's why they're letting them roll off the balance sheet and not selling them, okay? And then, of course, what worries, as you can see right here, this is the general account for the Treasury. What's worrying people is what happens when the whole debt ceiling thing is finally over, and let's say they raise it, no problem. What's going to happen when they fill up this general account? Because when they've done it before, the stock market goes down, okay? And so that's one thing you need to think about. Now, another one is NFCI. Again, this is one you saw a minute ago where I update every Wednesday on this one, because that's when this gets updated. This talks about Chicago Fed national financial conditions, whether they're tightening or they're loosening. The key is that line at zero, okay? It can be tightening. It's been tightening lately. But when you see it go over zero, that is excessive tightening, okay, or considered excessive tightening. When you see that, you normally see a recession. You can see in the dot-com bubble, which, by the way, is the weirdest crash ever, because they sold us off a year before we ever hit a recession, and you see the tightening never got above zero. But again, it was just this long drawn out bubble that burst. It just took a long time, and that might be kind of what we're in now. We'll have to figure this one out. But you can see excessive tightening, major recessions, okay, not just little ones. But and so that's the key. And we're not at the zero line yet. We've been tightening. We loosened starting in like July, I believe it was, and that's why you saw the big market rally, okay, in October that came up. And so that's what you got to keep in mind. And if we add on the cues for a visual, you can see exactly what I'm talking about here. Okay, I get this lined up here. You can see all of a sudden we get tightening standards, market sells off. Tightening standards, market sells off. Standards start tightening again, especially over zero. Market ends up selling off. That was the '08 crash. And so I hope you get the gist on that one. But you also see when they loosen, right? When standards loosen, what happens? The market goes up, right? Again, the dot-com bubble was the weirdest one ever because they started tightening, never got past zero, but then the market finally crashed. Even though you saw standards loosening as far as financial conditions, the market still crashed. That was just such a super bubble. It was insane with all the zombie companies and everything else. And so hopefully you got a good idea. Look at that, rewind if you need to. That liquidity is key. When it is injected, and before when I looked at this, it really wasn't that big a deal. But unfortunately, like I've showed you, if you've seen the videos in the past, in '08, this is, I would honestly say we don't even need to call it the stock market or the bond market anymore, or even the real estate market. We need to just call it the Fed market because they took it over. In '08, they took it all over, right? When they started buying mortgage-backed securities, being the #1 buyer of bonds and mortgage-backed securities, and just flooding the bank system and everything else, they just took them over as well. And so since then, that's why you got that huge run up when people couldn't figure out what's going on. That and stop buybacks, you just had tons of money. And in 2020, what happened? The Fed, the Treasury all step in again. And they say, no problem, we'll flood the market and take it back over because it's the Fed market now, right? And so that's what drives markets, like the #1 thing. As soon as liquidity starts leaving, the market just takes a dump. These charts miraculously show that no matter what's going on with the companies. All right, and now the other part is, the big part is it going to be a recession? What's going on? What do we look like underneath the hood? What does it look like behind the curtain, right? And so you can go look this stuff up, and what I do is I actually add this channel here. Now it's going to be recession watch, right? So all these charts I'm about to show you are in there. They're updated. Sometimes some are updated monthly, some are updated quarterly. So, it's key to understand this stuff, but I'm just going to start putting it in there. And you can see, so this is net percentage of domestic banks tightening standards for commercial and industrial loans for large and mid-cap businesses, okay? And you can see it's gotten really, really high, okay? And this is updated through Q1. It just continued to tighten. And you can see what happens. When they tighten, it usually leads to a recession. This is one of the things that always leads to a recession normally. Again, they updated in Q1, still tightening even more on small firms. Remember, we just talked about small firms, they're hiring and stuff. Well, they're tightening it up. It's over. It's already up to the process or up to the level of what they did in 2000 when we had the dot-com crash. It's up to, what is that, like 1988 crash, whatever it is. Hadn't reached '08, hadn't reached 2020. Of course, we shut down the world. Probably not, but it's still really, really high, okay? And so we're going to talk about that a little more in a minute. But then you got net percentage of domestic banks tightening standards for commercial real estate. We talked about this one before. And you can see it is tightening. I mean, it's almost up to the '08 level. It's way past any other level you've ever seen. And that's why you're going to see a problem where people are worried about commercial real estate when it comes to refinancing their debt at a much higher rate because they're going to be a much higher risk because like office space is a mess right now, okay? And why would a bank want to refi that debt and take on that risk? They don't want an office building. And then you got net percentage of domestic banks tightening standards for credit card loans. Now this is going to deal with us, right? So they're actually tightening now. And you can see where it started tightening is a big increase, okay? You see how far down that was? That's kind of crazy. If you move that up just a little bit, we would be at the same levels as like an '08. But we're just not there yet, but they're tightening, okay? Then you have this right here, net percentage of domestic banks tightening standards for consumer loans, excluding the credit card and auto loans. So this is going to be housing, things like that. It actually loosened in Q1. You can see a little dip down in Q1, right? And why do you think that is? And it's simple because we got so much equity in our home. Remember, auto cars, they depreciate, right? And credit cards are risky. There's nothing there, but we have so much equity in the houses. These banks are definitely willing to try to refinance, okay? Because it's kind of a no-brainer for them, to be honest with you. If we're willing to refinance at a higher rate, they're more than willing to take that house now. I'm not saying it's easy to get one. It's tightened, but not tightened anywhere near as much as like for credit cards and auto loans and other things like that, right? Or even for businesses for that matter. And so, of course, when you get these tightening standards, and we're going to talk about what is causing this as well, when I start reading this stuff off, what do you see happening? Delinquencies are always right behind it, or defaults, whichever way you want to put it, because you can see there's the tightening standards way up there, right? And the other line, which we don't have going up yet, is the delinquencies or the defaults. So this is something to keep in mind. As you can see, any other time, see how they go hand in hand with each other? I mean, it's like clockwork. I mean, it makes sense, right? The more they tighten, the higher rates people take out loans. If they do start to lose their jobs, then defaults and delinquencies start to pile up very, very quickly. And usually, when you look at it, in most cases, you see what's happening now. The tightening starts, and the delinquencies fall right behind. Not too far after, but it's definitely a number of months for sure. And now that leads us to the big one. How are we doing? How are companies doing when it comes to delinquencies? Ask yourself right now, are you or anybody you know, share in the comments, please, delinquent, right? Are you struggling? You can't find a job? That's what I want to know, because I haven't seen any of that so far. And I think that the employment numbers you saw come out this week kind of prove in a way that. But when you look, here's delinquencies rate on commercial real estate loans, right? We talked about this. Nope, ain't even popped up. If you look in 08, it was a disaster, right? Because the real estate market was a mess. But it don't have to pop up that much. Look at 2000, barely moved up at all. But here we got a little move up, little movement. But when you look, nothing really at all to look at, okay? Delinquency rate on business loans, all commercial banks. You see the big moves up, recession. Big moves up, you get a recession, right? You wouldn't even get a big move up there. And you look right there, it's nothing. I mean, that thing is actually going down. And so we're like record lows right now when it comes to that, okay? Then you look at delinquency rate on credit card loans, all commercial banks. Now, again, these are updated quarterly, so some of these are going through Q4 of 2022, some actually updated for the quarter. But you can see this one right here, this is about us, is going up. Now, that's the first thing usually you're going to see people defaulting on. It's going to be the credit cards, then the cars, and then, the house will be dead last. Then we go to delinquency rates on single-family homes, okay? And just look, nothing. It keeps going down, actually. No big move up. And dot-com bubble, you had a little move. 08 was, of course, the big one. But when you look over at what we're doing now, it's nothing, right? And you got to ask yourself, how many people you know that have actually had the houses foreclosed on them, that are actually delinquent on their mortgages, right? And so I don't know anybody, maybe you do, okay? And so then you got delinquency rates on consumer loans, all commercial banks, right? So these are all the loans, type of loans we can take out. You can see you got to pop up. You got to move up, right? And it happens every time before you go into recession. This is going to move up as the Fed is tightening and interest rates go up. It would make sense, right? And so again, a little move up, but look at where we're at. So it's record levels low, right? And the last one here, delinquency rate on all loans in all commercial banks. Okay, so all the loans combined together. Again, when you look at it as a whole, you just don't see it. The other times, big moves up. Now, little blip on the radar. See, look at that. And look how low it is at record levels, guys. And so let me know in the comments what you think about that. And if you want to become a member, you can click down on the link in the description box, and I'll track this stuff for you so you can get it updated daily and monthly. And also, it's still to this day, even with inflation coming down, less than a McDonald's combo. But this is the key, right? Where things can turn south fast. And I want you to take that when you look at those charts, go back and look at them again, right? If you remember, go in the Discord. I'll even send it on the Patreon for the heck of it. And you can pull them up and just look at them and try to examine every time we hit a recession what was going on. Because yes, it can turn fast. The unemployment numbers can turn fast. That's what happens. First, the unemployment numbers go, right? Unemployment goes up, right? Job openings come down. People lose their jobs. Then all of a sudden, they go through their savings. And then, of course, what happens? Defaults go, and it usually comes in a huge wave when that happens, okay? And it'll hit certain parts of the economy and stuff, or certain parts of the United States in certain areas. Now, that leads me to this right here. So it's important. I wanted to write this out as a visual. I don't do scripts or videos. And so when I wrote this out, I said, okay, so here's what we got for the negatives for the stock market. Because everybody, you got one camp saying we're in a new bull market, we're going to all-time highs. You got the other staunch camp, the bear, saying no way. And then you got people in the middle, which I would put me in the middle, saying, trying to figure out this data because some of it don't make any sense, not adding up because this is weird because we shut down the world. And so we're trying to figure this out because even when you hear the head of the Fed for the first time probably in history say now, twice now he said it, that we don't know how this is going to turn out. We have no idea. No textbooks, no models are working. They don't know, okay? And so here you have the negatives of the stock market. You got the Fed still raising rates. There's a 70% chance now after this job report they do a 25 basis point hike in May. Okay, people think that'll be the last one, but that puts us, what, to 5.25 to 5.5, if I'm not mistaken? Which is higher than we've been in years, by the way. Now, what is that happening? That is putting stress on the banks. And what are the banks doing? The banks are not lending out. Okay, the banks have said we are not lending out, not going to happen because they're afraid of bank runs. Okay, and I'm going to talk about what caused that. Okay, and so what's causing that is, I'll just say it now, you got money market funds, which we're piling into, right? The money market funds are actually parking a lot of that money, over half of it, into the Fed's repo program and drawing like, I think it's 4.88%. I could be wrong on that. Let me know in the comments if you know what it is. That's the last I read at least. And so what's happening to the banks? Well, that money's coming from somewhere. We're drawing it out of the banks. That's what's happening, right? And we're drawing out of the banks using these, by the way. That's what surprised the Fed when they said the bank runs were so fast, because for the first time we can use this. No way we couldn't do this on our phone. Now we can move everything with just a couple, clicks on the phone there, and boom, they're in deep trouble, right? And so now the bank's like, nope, they got all these loans they're taking out from the Fed. We're going to hold on to this stuff just in case there is a bank run or whatever. And so they're definitely not going to give out to us. I don't see that happening at all. Because why would you? And plus, they can take those loans out and take the rest of the money they have and just park it at the Fed repo program to themselves. Why not do that, right? Now, what else is this leading to because of the raising rates? The bond yields. The volatility is, I showed you 3 nights ago, whatever it was, off the charts for the 2 year. We've never even seen it like this before. It beats '08. That's what's crazy about it. I mean, it really does. That's crazy. Now, what's bad for the stock market also? Tina is dead, right? There is no other alternative. For 13 years, there was no other alternative. Now, all of a sudden, everyday Joes, as I showed you by Google, they're going and buying CDs. We're going and putting it in treasuries. We're going and putting it in money market funds, money market accounts. And we're finally able to actually draw some almost risk-free money for the first time in 13 years, right? And so that is not good for the stock market because it's not going in the stock market, right? And so, again, I talked about the money market funds, another thing, drawing money out of the stock market. And so then you got all the zombie companies. I showed you the bankruptcies are going up, and the bankruptcies should continue to go up because there was so many zombie companies created from 2010 to 2022, right? Or 2021. And so those zombie companies are the ones that got all that free money for free. They have no business being actually in business. They should be bankrupt. And so they'll continue. If the rates stay like it's supposed to, like for a year, you'll see a lot more of those companies going under. They're just going to have to because they make no money, right? Unprofitable, tons of debt. Commercial real estate is another one that's a whole X factor because like 1.3 trillion, I think it is, and commercial loans are coming due. Well, if you're in the apartment business, things are good. But if you're in the office space business and maybe even warehouses, you're in deep trouble, right? And so why would a bank take the risk on you like that? It makes no sense because if your interest rate's down, like way down here, and you want to refi up here, the bank's going to say, okay, they're probably not going to be able to pay this. So do we want an office building? Do we want a warehouse? I don't know. So that's something we're going to have to cross that bridge when we come to it. They can delay it for like 3 to 6 months before somebody steps in and says you can't do that anymore. So they can kick the can down the road. I do know that. I read that. Let's see. Treasury. Oh, the Treasury refilling the general account, which I talked about. People don't know because we saw what happened when they raised it up the first time. It wasn't throwing out liquidity. The stock market tanked, right? And so what's going to happen when this whole debt ceiling thing is behind us? I assume, I'm just giving them the benefit of the doubt, they'll work it out, okay? Again, and we'll just keep taking on more debt and spending the credit card, and they fill back up that account, and then that's flooding the market with liquidity. What's going to happen? That's what we got to find out, right? Because before, that general account meant nothing to no market to anything. But you take them 400 billion to 1.8 trillion, and again, I don't know how far they're going to take it back up. If you know in the comments, let me know. I haven't read anything about how far they're going to keep that up, right? Because the Fed balance sheet is unbelievable. They keep on to decrease it, but they can't, right? And so you got that going on. That, of course, is it going to lead to more bank failures if we keep pulling our deposits out more and more and putting them in these money market funds? And if they hold rates high for a long time, that's probably going to keep happening. And so, of course, the banks are upset, but, what are you going to do about it? That's the Fed's fault, okay? Now, when I say banks, I mean regional banks. The big banks I told you about where you got like 5 banks that have more assets than like all the regional banks combined. Well, they're getting bigger, right? They're actually getting our deposits. A lot of people are sending their deposits into Bank of America and things like that. Too big to fail, right? And so, again, kicking the can down the road on that one. Now, then you got the yield curve inversions going on. Remember, we're talking about negatives for the stock market, right? And the 3 and 10 year, my lower 3-month, 10 year, keeps getting more and more inverted. So that's usually the one that really tell you about a recession. So it's even yet to turn. And the last one for the stock market, probably a negative to me, is the fact you have like 10 to 15 stocks really holding up the market right now. The big money's just piling to Apple and Microsoft and all that stuff. And there's a reason for that because you got to remember, I looked up today, I think Apple alone has like $53 billion in cash. $53 billion in cash is sitting on the books. That's cash and investments, right? And I think, like I read, it's like 14 of them have over $1 trillion of cash and investments. $1 trillion, right? That's after all the stock buybacks, by the way. And so, I don't know what the Russell 2000, like every one of those companies have in cash and investments combined. I'd be interested to see if it actually beat those 14, to be honest with you. But, you know, that's why they're piling into those stocks, folks. If you ever wonder that, because their balance, their stuff is just a fortress, right? They could run just off the cash for quite a long time, and they do earn more interest on the cash on hand than their interest payments are on their debt. So they're good to go, and that's why they're being treated almost like value plays in a way, right? As safe havens. Now, positives for the stock market. Strongest job market we've ever seen in history. Never seen anything like it. I told people years ago, I said, when you shut that border down, good luck to you, because I was in the restaurant business, and I said, good luck to you, because Americans ain't doing those jobs. We ain't going in the fields, we're not going in the kitchens, all these different jobs these folks are willing to do for cheaper pay, we ain't going to do it. And if we do it, we're not going to do it for cheaper pay. So, and you can see what's happening now. So good luck with that. People making more money than ever? Absolutely. People, I mean, we've seen that on this job report. That continues to happen. People still leave their work and get a bigger raise when they leave. No student loan payments for 3 years, right? These are all positive because that's money that can go into investing. That's why it's a positive for the stock market, okay? And they're making more money so they can invest more, right? Credit scores through the roof, right? And so that's a positive thing because people aren't going to be, I showed you that on the delinquency report I keep showing you every quarter, right? Where it says people in those homes, much higher credit scores. I'm assuming they don't do these scores the same way they did in 08, and that's why they're higher. But either way, good credit scores, which means people are more financially sound in a way. I guess we want to put it that way. More equity in their homes than ever before, so you don't have to worry about being kicked out. If they do get in a struggle situation, they're not going to have to cut their retirement. They're putting in the IRAs automatically or 401ks and stuff. Think about that because they can go pull a line of equity on their house, take out a refinance, whatever they need to do, right? So it keeps the stock market from falling fast because there's a buffer here with our finances, right? Obviously, delinquencies are super low. I've already showed you that one. What could be seen as a positive for the stock market is the consumer, us, getting 3 to 5% of our money. If you want to roll that back into the stock market, you can. So that's actually something happening we've never been able to make happen before. Oh, and side hustles. Side hustles for people to make extra income are more easy to come by than ever. I mean, I said, if you want 3 jobs right now, you can have them, right? But they're so easy. You can start a YouTube channel. You can go on TikTok, shake your butt, whatever you do, right? And they can make money doing that to invest, right? So that's money flooding into the stock market, okay? And then also, I would think, this actually is positive. I'll talk about the cash on hand for those big mega caps that are holding up the stock market. Well, you know, people are less likely to sell those stocks, right? And so if those stocks don't go down, the market ain't going down either. That's just the way it is. I think we've seen this time and time again, right? 10 stocks on the NASDAQ 100 make up for 88% of the gains. Don't mean they can't go down, but as long as big money is still sitting in there and piling in there and pension funds are piling into them, and they say, well, they're good, they'll hold on to them a lot longer than they would have in the past, okay, and not sell them down. And again, it's because they make up such a high percentage in each index and in these ETFs and things like that. It's just not going to happen, right? Not as fast as it has before. Anyway, so let me know what you think about that. Now, this is where I need your help, because I sat down and thought about this. It's a year of first, right? Fed raising rates faster than they ever have, at least in my lifetime. I think if you're 55 and under, it's the fastest you've ever seen it. If you're in the 70s, I don't know how fast Volcker went to 20%. And so let me know in the comments what you think about that. More wealth than we've ever had across in equities, homes, treasuries, you name it. Definitely set up for that. Best job market we've ever seen in history. That's a first, right? And every time we think it's going to dip, it doesn't, right? Think about it. They thought it was going to drop off 6 months ago. And we're still sitting at 3.5% unemployment rate, right? And understand, companies want the unemployment rate up. They can't tell you that in your face, but they love it being up because when they have excess people looking for jobs, they don't have to give you raises. They can just give you the boot and go get somebody that's just happy to have a job. Now we're not in that situation, so make sure you keep that in mind, okay? The other one, inflation. Obviously, first time we've seen it, I mean, if you're, I guess, 55 and younger, whatever, and actually remember inflation. I mean, I was born in the 70s, but I don't remember it. And so, you know, keep that in mind and understand that what's really sucks about this is they got this new terminology now, and I've talked about this for months, called greedflation, because now we know, and I've shared this with you about the calls they do for the earnings, that almost like 30%, if not more, of the inflation we are seeing is companies raising their prices even that much more than inflation, or as far as that much more than what they're being charged to make these record profits during this time. That's the only way you could do that, right? Because if you're telling me You're having to pay out more to your employees. Well, where is the record profits coming from? What's it driving the bottom line? You may be cutting out the staplers and the pencils and everything like Google, but what you're doing is, and if you go to a grocery store, you know exactly what I'm talking about. It backs up my theory. For months I've been talking about this, and they finally got this terminology, that you're paying way more for those groceries than what Walmart is having to pay to get them in there, okay? And they will continue to do that until somebody steps in. And so that's my list, I think. Let me know if you can think of any more negatives, positive for the stock market, or first, okay? And so that's the data. Longer video than usual, obviously, if it's your first time here, but you are caught up. And the summary is simple. Right now, the consumer is just not in bad shape. I'm sorry, we're just not. That's the way it is. I'm sure some people are hurting. I've been saying that for a whole year, that if you make a certain income level below, you're hurting. Inflation is just crushing you. I get it. And if you make a certain income level below, you're not in the stock market either, okay, or struggling to get in the stock market or find money to actually put in there, things like that. I get it. I'm not saying that, okay? What I'm saying is the majority are still doing fine anywhere you go, right? Disney packed out, everything's packed out. Just took my son literally an hour to go see the new Mario Bros. Movie. Not a seat available on any showing, okay? And not from today, tomorrow, next day. Every time I go there, sold out, okay? And so we're still doing our thing. Grocery stores are still packed. Everything's, that way. So again, doesn't mean you can't turn fast. I'm not saying that. That's how it happens. But right now, pending some, financial crisis or credit crisis that the Fed causes, right? We're just still going where we're going right now. There's still a lot of uncertainty in the market. I get that. There's no doubt about it. All right. So let me know what you think down in the comments and what you think about this kind of video. Just let me know. Okay. So hit the like and subscribe button if you got anything out of it. Think about sharing it with your friends and family if you want to. And let them be updated. Okay. Let's use some facts. So enjoy your time. Sorry it was so long, but I'll see you Sunday.